Hello guys, happy to see you again in my video. This will be my final video after attending the whole class of corporate finance at IPMI International Business School with the lecturer Professor Sembel. So in this video, I will be sharing with you about the whole class with the mind mapping methodology, and then hopefully you could get all the summary of the whole class that I have attended. So if you recall the previous videos, the first thing that we learned is about the financial management. So financial management is about the optimum orchestration about the internal and external financial resources towards the significant and sustainable value creation. And there are four main goals or four main objectives of financial management. The first one is basic objective, the second one is operational objectives, and then the third one is social objectives, and then the very last one is the research objectives. Within this financial management, we also learn about the cash flow structure between the firms and the financial market, how the cash flow from the financial market goes to the firms, and then the firms will retain the cash flow. And then from the cash flow, the firm will pay in form of dividend, and beside the dividend, the firms is also paying taxes to the government. And moreover, behind those numbers, there are potential principal agent problems that present the potential conflict of interest between the BODs, the management, and between the shareholders. And one of the things to minimize the potential problems out of these principal agent problems are governance, or good corporate governance, which will promote the transparency, accountability, responsibility, independency, and also fairness, or we simplify it as tariff. And in this chapter, we also learn about the time value of money, which learn about that receiving $1 today is worth than receiving $1 in the future due to the opportunity cost. How we value or how we calculate the value about the money in the future, we call it compounding. And how we calculate the present value out of or from the future value, we call it discounting. So that is the first part that we learn about the financial management. And then we move on to the second part of our courses, which is capital budgeting. So capital budgeting is about the planning process for investment in the long-term assets. So the first methodology of capital budgeting is the payback period. Payback period is as if that we are asking ourselves that how many years does it take to cover the initial investment. The other methodologies are the net present value or NPV, and then the profitability index or PI, and then the last one is the internal rate of return or the IRR. And all those three methodologies consider all cash flows, time value of money, and also the required rate of return. We also learn about how we balance about the return, potential return versus the risk of the investment. And deep down inside, we also learn about the passive investing and also active investing, which passive investing is we just invest in following the market. Meanwhile, active investing, then we look at some parameters, fundamental analysis, technical analysis, and the last one is market or investment sentiment. So for the quick summary, actually the capital budgeting concept is we will estimate the expected future cash flows, and then also we will evaluate the project based on capital budgeting evaluation criteria, and then we will decide whether or which project is good or not good. So that would be all for the chapter 2 or the part 2 of our courses in capital budgeting. And then we move on to the part 3 of our courses about the securities analysis and also the portfolio investment. The first interesting thing that we learn is about the Warren Buffett. We all know that Warren Buffett is a very famous person, which is America's #1 richest people in 2008. So he started all the way from 1956 from $100 investment all the way to 1998 to become around 33 billion worth investment. We also learn about the famous Warren Buffett way, which consists of 4 things. First one is turn off the stock market, and then second one is don't worry about the economy, and then we should buy a business instead of a stock. And then the last one, we should manage the portfolio of the business. And the very last one about Warren Buffett, we learned about his 4 tenets, which are business tenets, management tenets, financial tenets, and also the market tenets. We also learned about the financial statement analysis. From the financial statement, we should be able to look at, first one is about the return potential. So from the profitability parameters, for example, like return of asset and also return on investment. And then about the risk, from the liquidity, for example, about the current ratio, quick ratio. And then the next one is about, again, the return from the activity, for example, like total asset turnover and total fixed asset turnover. And then about the potential risk, for example, like from the leverage parameters, for example, debt to asset ratio and debt to equity ratio. And then also we could see from the market ratio, for example, the dividend yield and also price earning ratio. And then we also learned about the DuPont analysis, that we break down the return on equity to several parameters, for example, about the net profit margin, total asset ratio, return on an asset, and then also debt ratio. And out of those ratios, we might be able to conclude the return on equity from the firm. So that would be for the part 3 of the courses, which is about the securities analysis and portfolio investment. And now we move on to the capital structure and corporate structures, which is the 4th part of the courses. We learn about the CAPM model or capital asset pricing model, which allow us to understand about the risk-free rate and then also the market risk premium. And then from those parameters, we would be able to know about our estimated return of our investment. We also briefly learn about the SAINS principle for our personal finance. SAINS stands for the save and invest and then spend. And we may choose the instrument of mutual fund. And then about the capital structures, which consists of debt and shareholders' equity. We learn about the capital structure of the company. From the Modigliani and Miller theory about the capital structure theory, we know the assumption that no transaction costs, no taxes, everyone has the same information and borrowing rates, and debt is riskless and debt does not affect the operation. This is the flat line. And then both of these guys also wrote an important paper in 1958 in which they proved that with tax deductibility of interest payments, the optimal capital structure is 100% of debt. From the 4 courses, we also learn about the sovereign wealth fund. So what is actually about the sovereign wealth fund? So basically, sovereign wealth fund is a state-owned investment fund comprised of money generated by the government, often derived from a country's surplus reserves. There are 4 types of sovereign wealth fund, which are stabilization fund, future generation fund, reserve investment fund, and also the last one is pension reserve fund. Despite the good potential of the sovereign wealth fund, but there are also some possible problems with sovereign wealth fund, which are good governance issues, strategic investment allocation issues, unclear regulatory issues, high cost of capital issues, and also government guarantee. And still within these 4 courses, we also learn about the financial distress, about the potential financial distress and the potential solution of the financial distress, which mainly comprise from 2 solutions, which is the turnaround opportunity, and the second one is in case the financial distress become a permanent problem. So that would be the chapter 4 of the courses. And now we arrive to the part 5 of the courses, which is about the fraud management and dividend policy. We learn about the occupational fraud and abuse. So the first example is corruption, and then the second one is the asset misappropriation, and the last one is the fraudulent statement. So basically, fraud is committed or happen due to the main 3 features, which is often called as the triangle of fraud. So the first one is opportunity, and then also there is a pressure, and then also the last one is rationalization or justification. And how we could prevent fraud? So we should build employees' ethics, and then we should write clear SOP or standard operating procedures, and then we should train employees to increase the alertness for any kind of potential fraud. And then we should have protective security in both hardware and software. And then the last one, that we should create the whistleblower. in this course number 5, we also learn about if the company of whether a firm should pay a dividend. So dividend policy really involves two main decisions. The first one is how much of the firm's earning that should be distributed to the shareholders as dividends. And then the second one is how much that should be retained for capital investment. So these are the 5 considerations behind the analysis about how that dividends matter. First one is residual dividend theory, and then the second one is the clientele effects, and then the third one is information effects, and then the agency cost, and the number 5 is expectation theory. So our group got the chance to review about the Trading Places movie. So by watching the movie, we should be able to summarize at least 4 things. The first one is we need to summarize the movies. What is the movies all about, especially in terms about financial issues. And then the second one, we should be able to explain about the fraudulent transactions from that movies. And then that fraudulent transaction, is it ethical or is it illegal? And then the last one is what would be our financial lessons from the movies. So that would be our part number 5 from the courses. And then now we move on to the part 6 of the courses, which is about international finance. The first thing about international finance is about the foreign exchange market that allow currencies to be exchanged in order to facilitate international trade or financial transactions. And it has evolved from the gold standard to agreement on the fixed exchange rates to a floating rate systems. And then we learned about the currency futures and option markets. So currency futures contracts actually specify a standard volume of a particular currency to be exchanged on a specific settlement date. They are sold on exchanges, unlike the forward contracts. And meanwhile, for the currency call or put options, give the right to sell or to buy a specific currency at a specific price, used to be called as the strike or the exercise price, within a specific period of time. So basically a quick introduction about options. So option is a contract that gives its holder a right to buy. So that would be all from the chapter 6 of the courses. And now we have come to the last part of our lessons, which is about the event analysis and the portfolio evaluation. And this is again a group assignment. Our group has got the chance to analyze about the Sritex local company, which is textile manufacturing, which we found from the news that Sritex is going to restructure their debt to improve from their financial problems. So that would be closing these mind mapping videos. Hope you all could get the ideas of these whole courses from this mind mapping video. Thank you so much for visiting my video. Hopefully you all could get good takeaways from this video. Again, thank you so much, and thank you again for checking out my videos. See you again soon, and bye bye.